It's time for the Your Personal Bank Show with Ferenc Toth, president and founder of Secure Estate Management. Take charge of your financial future with your personal bank. Now, here's Ferenc Toth.
Welcome to the Your Personal Bank Show. It's Ferenc. We're going to cover a lot of great stuff. I know last week, if you didn't hear last week, check it out. I answered some questions, shared my background, how I learned about this concept, the Your Personal Bank concept. Shared a lot about how to think differently about money, how the ultra-wealthy think about money often, and how to reduce stress in your life, particularly financial stress. Less stress means a better life. It's just that simple. So if you want to go back and listen, you missed last week's show, go to yourpersonalbank.com and you can check it out. All the previously recorded shows are there. You can also contact us if you have any questions. And our number is, of course, toll-free 866-515-6280. I've been asked to share more about some more financial literacy ideas and concepts because, as I shared in last week's show, this is something that financial literacy is sorely lacking in America today. It's been hijacked, if you will, in many ways by the IRA, 401k, mutual fund world. It's not taught historically in the homes like it used to be. When you go back, parents, grandparents, dad used to teach that typically. We just came from backgrounds where it's really sad, but, our parents didn't have strong financial literacy in their lives. And, if they didn't understand it, live it, or use it themselves, how are they going to teach it? As kids, we learn more by, as kids are caught, more than taught. In other words, they learn from what people do, their parents do, more than what they tell them. I think most people understand that. So I've been asked to share more things on some of these financial literacy topics, which I share a lot of times with my workshops. I'll be doing one in January here in Phoenix coming up. As we get closer, we'll give more information on dates and stuff like that, but it'll be the last Saturday in January. But one of the things, I get really positive feedback and responses when I share these financial literacy concepts. And the first one I've been sharing with a lot over the last several shows is, again, taking control of your money, having access to funds while not defeating the long-term future, paying penalties, paying taxes, or losing the compound growth on your money in the future, like most accounts do, most investments, is powerful. It's a powerful tool to be successful in business, in life, personally, when things go wrong, when you have opportunities present themselves. Having easy access to money without credit checks, applications, like I said, taxes or penalty consequences, is powerful. And being able to still build long-term compound growth for the future is a powerful, powerful tool. Another one, and if you want more information, like I said, go to yourpersonalbank.com, listen to last week's show or some of the previous shows where I cover that in more depth. What I want to talk to today is what another wealth key I've shared often in workshops is called the 80-10-10 rule. Now, this isn't a new one. By the way, none of these financial literacy concepts are new. They've been around for the ages. I mean, we're talking forever, centuries, as long as mankind's been around, okay? What is the 80-10-10 rule? And by the way, you can find the 80-10-10 rule in a myriad of different books, all kinds of different sources. It's financial literacy for the ages, if you will. And really what it is it's live on 80%, save 10%, and give away 10%. You've probably heard this before, somewhere along the line. But here's the thing. Why is it so important? Well, like I said last week, what causes financial stress? Well, lack of financial resources, not having enough, right? Number one, a cause of divorce, is often said, is lack of financial problems. And usually it's a lack of those finances that cause a problem, or disagreement among the partners on how those financial assets should be allocated, okay? So it causes a lot of stress in life, okay? So here's the thing. Why is the 80-10-10 rule so important? And one of the things I share with people is you can believe in this. You can believe this rule or not. That's fine. Doesn't matter. You can also tell me gravity doesn't exist, jump off a tall building, and we all know what's going to happen. You're going to go splat on the bottom, aren't you? So again, apply these rules in your life or don't to your peril, okay? So I'm going to use an example that most of us are familiar with in terms of how applying the 80-10-10 rule is so important, okay? Oh, by the way, well, let's use the example first. Let's say you want to buy a new home, and you go and you get pre-qualified for the home, So a lender says they're going to loan you, let's say $500,000. So that's what you qualified for your home, right? And here's the thing, what you need to understand. And by the way, most people, what do? When they qualify for $500,000 home, what do? They go shopping for homes around that price range, don't they? Now, here's the thing you need to understand. It's not an approval saying, hey, you can go out and borrow $500,000. It's the loan qualification. Understand, I'm a banker also. One of my hats, I'm the chairman of the board of a bank in formation right now. And I deal with a lot of bank stuff. And I'm going to tell you, the bank or the lender, if you qualified for $500,000 loan, what it means is that's the maximum amount of funds that the lender's willing to give you. In other words, that's the maximum amount of risk. It's a risk assessment from the lender. Anything over $500,000 is too risky from their viewpoint. Their determination is stated, hey, based on your income, your assets, your capability of paying back the loan and such, we'll go up to $500,000, but not over, because anything over that is too risky. In other words, they feel like the odds of you not being able to pay it back are too great. So they've made a line in the sand. They put a marker down. And most people go to that line or even a hair above if they can. They go as close to that line as they can. Well, what has that done? Remember, it's a risk assessment. You've maximized your risk. You've done the maximum amount of what a lender says they feel like, in their opinion, in their professional opinion, that they feel like you can do, that you can accomplish. It leaves no wiggle room, basically. It maximizes your stress. If anything goes wrong, what happens? You've got no cushion, or very little to speak of, okay? That's the problem. It leaves a minimum cushion is what it does. And again, if anything goes wrong, you have a lack of income, a job change, an economy changes, the business income, get sick or hurt, can't work, any of those things happen, it equals stress, doesn't it? Now, here's the problem we all face. Everyone's motivation around this process of purchasing a new home, for example, everyone's motivation around you is for you to maximize what your amount you're approved for. In other words, the seller wants to sell the house, whatever it is you're looking at, right? The real estate agent that you work with do they make more commission on a $500,000 house or a $400,000 house? Well, that's pretty obvious. They want to sell the bigger house, the bigger price. So they're showing you tell a real estate agent you've been qualified for $500,000. What are they showing you? Well, they're showing you the maximum that they can. The lender wants to earn more interest, so they'd rather lend you the $500 than $400, okay, because they're going to earn more, and they've agreed to do that. The mortgage broker they get paid commission based on the size of the loan, so they want the bigger loan also. You know, everyone around you, around the process, is pushing you towards that bigger number, the maximized number. In our example, $500,000. Here's what you have to do. Oh, and by the way, real estate investors, business people, are often just as guilty as homeowners. They go for the bigger, they qualify for the $500,000 to buy their investment property or whatever, to rental or fix and flip or whatever it is they're doing. And they're motivated to earn more profit, so they earn more profit on a bigger property, typically. Again, little or no cushion, which if something goes wrong, there's delays, what happens? Stress. And you got to ask yourself the question, is it worth it? Okay? See, here's the thing. Typically, is a $500,000 house nicer than a $400,000 house? In most cases, yes. Is a $50,000 car nicer than a $40,000 car? Most cases, again, yes. Is a $5,000, computer system or whatever nicer, or TV, let's say, nicer than a is a $5,000 TV nicer than a $4,000 TV? Sure it is, in most cases. The question you have to answer is the potential stress worth it? We all like nicer things. Of course we do. Here's what you have to do. This is the financial literacy key. Here's the secret to success on this. If your approval is $500,000, in our example, and you're looking at homes, if you walk into one of those, you're going to naturally, human nature, you're going to want it. It's going to have the nicer kitchen, the nicer yard, the better neighborhood, whatever, and you're going to move towards wanting it, and you're going to get it, and you're going to push yourself, you're going to end up probably buying it. What you do is you tell the real estate agent, here's the secret. Okay, listen up. This is the key. Here's the secret. You don't tempt yourself. You don't allow yourself to look at the $500,000 house or the $50,000 car or the $5,000 TV. You look at the $400,000 house, the $40,000 car, or the $4,000 TV. Okay? In other words, you tell the real estate agent, my qualification is 400, not 5. I don't care what the paper says, what the numbers say. If you show me a house that is going to cost more than $400,000 when it's all said and done, I will fire you and find a different agent. You have to take control. And when you go to the car dealer, it's the same thing. When you tell the salesperson, I can afford $40,000, even though you qualify for $50,000, let's say. You tell that salesperson, if you show me a car that's going to run me more than $40,000 when it's all said and done, I will go to a different place, a different dealer, a different salesperson. I will walk away immediately. And you make it very clear. That is the key to success on the 80-10-10 rule. You stay at about 80% of what you can afford, what you can handle. This is something that's broken constantly by Americans at their own peril, and why so many people are under so much financial stress. This is the Your Personal Bank Show. Contact us at yourpersonalbank.com for more information, and tune in Tuesdays at 15:10 a.m. or 105.3, Tuesdays at noon, I should say, for the Your Personal Bank Show.
For more information on Your Personal Bank, call Ference at 866-515-6280 or online at yourpersonalbank.com. Back to Your Personal Bank Show with President and Founder of Secure Estate Management, Ference Toth.
Welcome back to Your Personal Bank Show. I've been sharing a very powerful financial literacy concept called the 80-10-10 rule. This is not a new rule. This is something that's been around for the ages. It's been around forever. And what is it? 80-10-10 rule is live on 80% of what you earn, put away 10%, and give away 10%. Now, I've talked about what to do, have the secret, have how to protect yourself from, say, overextending. If you're going to buy a house and you qualify for a $500,000 loan, don't look at a property that's more than $400,000. If you tell your real estate agent, you show me something that's more than $400,000 all said and done, I'll fire you and find somebody else. You tell the salesperson, the car dealer, the same thing. If you can afford a $50,000 car, 40 is your top limit when it's all said and done. If he shows you anything over that, he or she shows you more, you fire them and you find somebody else or go to a different dealership. You take control. That's the key. You have to take control, because is it comfortable for a lot of people? No. But you have to keep in mind, is the potential financial stress worth it? Because whenever you overextend or you go to the limit or close to the limit of what you can afford, what a lender has approved, remember, it's a risk assessment. What the lender has said, the maximum they're willing to loan you, that means there's little or not much wiggle room beyond that. And when that wiggle room, when things go wrong, that cushion, you have little or no cushion, it causes stress, right? Now, here's the thing. 80-10-10. Why put away 10%? Well, that should be pretty obvious, because as I shared in the last show last week, if you're putting away 10% of what you earn on a regular basis, what happens over time? You create a nest egg. Now, as you build your nest egg and your reserve, your cash reserve, financial advisors financial advice for the ages has said you should have 6 to 12 months of cash reserves, for emergency funds. I don't think anybody would argue with that's a bad idea. Yet the average American, there's studies that show that something like upwards of 30-40% of Americans, if they lost one paycheck or two paychecks, they'd be in financial trouble. It's because they've overextended. They're going up to the limits and borrowing or spending on what they could afford, okay, which is creating stress. If you put away 10% of what you make over time, even if it's a small amount, doesn't matter. Over time, it builds, and you build that cushion, that cash reserve. Now, obviously, we talk a lot about that cash reserve because you can put it in the bank today, that cash reserve, like a lot of people do. And what kind of interest rate are you earning on that money today in bank accounts and money markets and CDs and such? Very low interest, okay? Next to nothing in many cases. So we talk about, hey, take that cash reserve, put it into a personal bank product, and at least earn, double, triple, quadruple of what you'd earn in the bank easily. with safety and some tax favored benefits and guarantees and all that. So it's a great tool. Plus, you have a death benefit protection tool and a long-term care benefit built in at no additional cost for those things when those things happen. So it makes a lot of sense. One of the reasons why we talk about budgeting and spending and the 80-10-10 a lot of time, because I have a lot of clients in my life that I've worked with over the years, and even myself personally, I've seen the changes in their life dramatically. I remember one couple, for example, a couple of years ago, met with them originally, and flat out told them if they didn't change what they were doing, because they had a tremendous amount of debt, credit card debt in their case, the next person they were going to need to meet with was a bankruptcy attorney because they were going down the tubes. They changed how they were handling their business. They changed some of their spending, different things that was happening. And I remember a year and a half later, meeting with them for lunch, and it was like we were attending it was like going to a party. And I even commented, remember when we met the first time versus this time? And we'd met a couple, 2 or 3 times throughout and had some calls and stuff. The difference. And they looked at each other, they go, really, is it that noticeable? I said, it's like night and day. The first meeting I had with you was like going to a funeral. This one's like a party. And they're like, yeah, you're right. Life is a lot better. I've experienced this myself personally, my wife and I. Back in we were in the real estate. We did a lot of real estate investing. We did developing. I've shared that. If you want more information on my background, go to yourpersonalbank.com. Have all the previously recorded shows. Last week's show, I talked about on the November 12th show, the first segment, talked a lot about my background as a business owner, owned several businesses, retail, financial services, real estate, starting a bank now as chairman of the board of a community bank in formation. So I've got a lot of business and varied business experience, okay, and had some real tremendous successes and some failures, frankly, in that. Again, if somebody hasn't succeeded, somebody tells you they've never done anything wrong, they've never either done anything or they're probably lying. So not telling the whole truth. The point is, it creates a lot of stress when you don't have that cash reserve, you don't have that cushion, and you overextend. And that's what the 80-10-10 is all about. By the way, what's the giveaway 10%? What's that all about? Well, it's not that I'm not here to, talk about somebody's faith or anything like that. But there's some practical reasons for it. One is it's good for your taxes. You get deductions. In fact, for most people, if you're not a business owner filing the 1040 long form with a lot of deductions, it's one of the few deductions the average individual has left. Because according to the IRS, since the new tax laws went into effect in 2017, something like 94 to 95% of Americans no longer take advantage or use the mortgage deduction, for example, because the standard deduction is doubled. And most people, particularly a married couple, if you don't have that much in mortgage interest, you're going to take the standard deduction because it's higher. So you either take the standard on the short form or you do the long form and itemize. And so over 90%, according to the IRS, do not use the mortgage deduction because the standard deduction is higher anyway. So that's one of the few deductions left for the average American. So giving something away, donating to whatever good causes that are out there, creates that tax deduction. Okay, so it's certainly helpful from a practical standpoint. It also goes back to control. I've talked a lot about control of your money. If you find it difficult to give any money away, what that does, again, this is a human nature thing, it's demonstrating, and I'm not trying to pick on anybody, I've been there, it's demonstrating that money is controlling you versus you controlling it. If it's difficult, if you find it emotionally difficult to give money away, it means it controls you. Instead of you looking at it as a tool, it's just a tool. Money's agnostic. It's not good. It's not bad. The common saying, it's people are familiar with, money's evil. No, the love of money is evil. That's what the Bible says. Here's the thing. Do you control money or does it control you? And if you can't see fit to give something away, obviously there's practical reasons for it. Like I said, tax deductions for one, it's controlling you. You're a slave to it. And again, why is this important? Well, if you want to operate like the top 1 or 2%, the first thing you need to do is think like the top 1 or 2%. And I can tell you, when you talk to the ultra-wealthy, money is not an issue in their life because they have plenty of it. Most of them are not overly consumed by it, by the way, in most cases that I deal with clients and folks that I know in that arena. In fact, they just look at it as a tool. In many cases, you have heard this. Many people have said this. Very successful people. It's just a game. Money's just it's like a game, and that's the way to count whether you're winning or losing the game. Okay, so it's a tool. They use it as a tool. They think it's agnostic. It's not good or bad. It's just a tool that accomplishes things that they want to do and covers things that they need. Okay, it doesn't control them. It doesn't consume them. It doesn't control them. And what I find interesting is when I meet with clients, I met with thousands of clients in my 22-year career, and I've met with folks from all facets of the economic spectrum. And I find in general, and I think most financial advisors and agents and such could agree with this, that you find the people that have less think about money more and stress about it much more than in general than those that have more. Certainly there's those that are miserly and obsessed. There's those kind of people, but that's a minority. The majority of people who actually have plenty don't really think about money that much. It's not a big factor in their life. It's not a big challenge. It's not a stress. It's not a problem. Well, before you can get there, you got to think. The first step before you can accomplish anything is you got to change your thinking. The 12-step program, thankfully that's not a challenge I've had, but I think everyone knows this. What if you're an alcoholic or have a drug problem or whatever it may be, what's the first step of the 12-step program? Admit you have a problem. And that's half the battle, isn't it? If you have a challenge about money and you find money's controlling you instead of you controlling it, well, the first step to solve the problem is admit that that's a problem. Start changing your thinking. Start changing the thinking, a paradigm shift in thinking. Start taking control of your money. And that's where Your Personal Bank really comes in to help you control your money, have access to your money while growing long-term, tax-favored with guarantees. You're listening to Your Personal Bank Show. Contact us at yourpersonalbank.com for more information. And tune in on Tuesdays at noon on Money Radio, 1510 AM or 105.3 FM.
For more information on Your Personal Bank, call Ference at 866-515-6280 or online at yourpersonalbank.com. Back to Your Personal Bank Show with President and Founder of Secure Estate Management, Ference Toth.
Welcome back to the Your Personal Bank Show. Been covering a lot of great stuff today. It's been a lot of fun. I've really been talking a lot about the 80-10-10 rule. What is that? Live on 80%, save 10%, give away 10%. Wow, that sounds tough sometimes. But here's the thing. It's a financial rule for the ages. Break it at your own peril. You believe in it or don't believe in it, but there's a lot of power in living on 80% of what you earn, whatever that is, okay? So at whatever point you are in your life, living on the 80% is powerful because what does that do? If you put away 10% over time, you build a nest egg, take care of emergencies, a cushion, you have reserves. And the biggest thing about that is you reduce your financial stress. I've been there both sides of it. I can tell you personally, when you build a bigger and bigger cushion, in other words, if you didn't work for 6 months or a year or 2 or 5, and you still had enough money in reserve and not take away from your future, your stress levels go way down. I'm just telling you, it's true. My wife said this one day. I remember it was a couple years ago or so. She said something. She goes, money doesn't make you happy. But man, it sure does reduce a lot of stress when you have it. And we've had money and we've been broke, okay? We've been on both sides of it. So here's the thing. Live on 80%, put away 10%. Why should you give away 10%? Well, practical reasons. It's good for your tax return. You can get deductions, okay? So that's helpful. And secondly, it's just you're taking control. Again, money's not controlling you. You're controlling it. You understanding it. You're operating as it's a tool. It's a tool no different than a computer is a tool, okay? It's not good. It's not bad. A lot of people have personal hang-ups about money. I run into that often too. It's funny, my wife's also a postmaster's degree in human behavior, and she's worked with me with many clients over the years. I've been involved, and she says, gosh, it seems like half the time you're doing psychology, financial psychology with people. I said, yeah, because it's amazing how many people have hang-ups and challenges and baggage about money out there. Often I find even as much, if not more so, than with relationships. It's just truly amazing. And those things come from a lot of times how we were raised, how we grew up. I've got, a good friend of mine. I remember he worked for me for years, and one day he came in and he says, I've never actually sold a big case, over $100,000 case. And he'd been doing this for a number of years, and he was one of our top producers in the company. But and I didn't really realize it at that point until he brought it up. And he says, and I think I figured out why. Because he was successful, but never did the big cases. He just did lots and lots of smaller cases. And I said, why do you think that? And he looked at me, he goes, because every Sunday after church, my parents would drive us around town and take us to the nice part of town and show us all the big after lunch. And we go to look at the houses as kids. He would do this. See those folks? They're crooks. And then drive to the next house. See those people? They took advantage of so-and-so, and that's how they got their house. And see those people? In other words, it was drilled into their head that money was evil. And having too much was a bad thing. You were a bad person. Sadly, that's not uncommon out there. It's not an uncommon thing. What was interesting, we talked about it a little while, and he came to realize that, just because somebody had more money than someone else didn't mean they were an evil person or a bad person or took advantage of somebody to get there. There's a lot of people, certainly there's cases of that. I'm not going to argue that fact, but the vast majority of the time I find, and again, I'm working with clients, I'm looking at their financial statements, tax returns and whatnot, so it's kind of hard to lie to me. Folks who have been successful and have more, in most cases, it's just because they've worked harder and they've applied themselves and they found a niche or found something that they were good at and had a passion for, and in many cases helped other people, and they became valuable, in the economy, and they earn more as a result of it. It's kind of that simple. The interesting thing was, literally the next week or two, he saw this agent I was telling you about, who had this hang-up about money, didn't even realize it for years. After really identifying it, the next week he sold his first big case to a client. So, like I said in the last segment, the first step in this 12-step program, if somebody's got a problem, is admitting you've got a problem. If you've got a challenge with money in terms of control, and one of the things is, I've seen this said before, if you want me to show you what's important to you, show me your checkbook balance and show me what you're spending money on, and that's what's important to you. If you have a challenge living on 80% and putting away 10 and giving away 10, you're out of balance with money. And if you're out of balance, eventually it's going to catch up to you, and you're going to run into challenges, problems, and stress. It's a fact of life. It's going to happen. You might get away for a while, but eventually it's going to catch up to you. Now, if you say to me, Ference, gosh, that's all great. I mean, I share this at workshops and stuff, and I get tremendous positive feedback. It's all true, and I'll tell you, I haven't always lived that way myself. I mean, I've done both sides of it. But man, I just can't see where I could live on 80% right now. I said, I get it. Take a step in the right direction. Can you live on 98%? Can you put away 1% and give away 1% to start? I don't know. Or 5%. I don't know. Whatever that number is, but start the process. Start somewhere. And what'll happen is over time, again, you'll build that nest egg and you can build on it. You'll realize your stress levels start to dissipate. Because if you're living like about a third, 30, 40% of Americans, I've seen multiple studies on this repeatedly, that if you miss a paycheck or two, they'd be in financial dire straits. That's stressful, folks, period. I don't care how you cut it. If you can fix that somehow or start taking the steps, do so. Now, why do I talk about this so much? Well, given that 10% you put away as you build a nest egg, a great option is the personal bank, because you can put it in a traditional bank account like a lot of people do, those emergency funds, reserves. We've all been told you should have 6 to 12 months of cash reserves for emergency fund, that kind of thing. And that's all good, solid, valuable advice. But what kind of rate of return are you earning in banks today with checking, saving, money market CDs? Very low rates of return. Why not put it into a personal bank product that's probably going to earn you, probably in most cases, I find 3 to 4 times, 5 times sometimes more money. Some of these accounts are earning 0.00 something, so much more return on your money, having access, having tax-favored growth, building for the long term, having a long-term care benefit built in at no additional cost, and a death benefit built in. God forbid something catastrophic happened. Those are all good things. So it's a great source, it's a great place for where your personal bank can fit in. I see it fit in for many, many, many clients that I've worked with. It's a great place to start. How do you gain financial literacy? That's one of the other questions I get all the time. Well, there's really 3 main ways I've learned that we learn, and this is from many different books and such I've read over the years. One is the School of Hard Knocks. That's that's the hardest one. We do tend to learn the lessons the best that way, though. Learning by your mistakes. Let's face it. We rarely learn from successes, but there's often lessons in mistakes. Okay, hard lessons often, and that's where you can learn this stuff. Of course, the second way is mentors. Wisdom is actually learning from other people's experiences. That's a powerful way to learn. And I didn't have mentors earlier in my life, and I had made a lot of missteps because I wasn't taught this stuff either growing up. Okay, had to learn the hard way in many cases. But I've come to learn after I got bashed in the head enough times, and many of you, I'm sure, smiling, know what I'm talking about. I mention that to people, and you smile. Yeah, I remember the time I got bashed in the head. When we're young and stupid, and we think we conquer the world, and we think we know better. And then we get bashed in the head a few times. We start realizing, wait a minute, maybe I better learn some lessons here. Mentors become very valuable. And I've got a number of mentors in my life today. So when it comes to a big decision in certain areas, I won't take action on that decision without bouncing it by my mentor in that arena. I don't have one mentor that covers everything because nobody is great at everything. Okay? And, wisdom is having a number of counselors, right? And then the last one is books. Gosh, there's a wealth of wisdom out there that you can read. Lots and lots of things you can read on books and stuff and learn. And, the last thing on that is, the average American, by the way, this was a study I read recently. The average American reads 1.5 books a year. And the majority of those are romance novels, by the way, statistically. The average corporate CEO, and I think we can all agree that those are busy people, they read 50 books a year. Now, we can't say they're too busy. It's just a priority thing. And I'd say in most cases, the average corporate CEO makes a lot more and has a lot healthier view of money than the average American does. So is there a difference? Yes. Again, why am I sharing all this? Your personal bank is a paradigm shift in thinking about money, and it's thinking about money in the way that many of the ultra-wealthy think. And if you're going to change your future, your financial future, the first thing you got to do is change your thinking. Actions follow thought, not the other way around. If you want more information, contact your personal bank or tune in on Tuesdays at noon to Money Radio, 1510 AM or 105.3 FM.
For more information on your personal bank, call Ference at 866-515-6280 or online at yourpersonalbank.com. Back to Your Personal Bank Show with President and Founder of Secure Estate Management, Ference Toth.
Welcome back to the Your Personal Bank Show. We're round and third. We've been covering a lot of great stuff today. First segment, we really talked, and the second segment, talked a lot about the 80-10-10 rule. What is the 80-10-10 rule? Live on 80%, save 10%, and give away 10%. Whew, that sounds rough sometimes, and it can be. But it's one of those rules. It's been around, financial rule for the ages, and it's just one of those things you have to follow and live by Because if you don't, you can get away with it for a while, but eventually something's going to happen and something's going to go wrong. And then you're going to face financial stress as a result. So how do you avoid financial stress? How do you avoid stress in general? Financial stress being one of the most common ones. Well, by building that nest egg over time, that 10% you're putting away, over time, guess what? As you have more and more cash reserves, you have less and less stress. It's kind of like a teeter-totter. It's an inverse proportion. It's amazing. I've lived it myself personally. I've been on both sides of the coin. As you put more and more away, and you know you've got more and more reserves for that rainy day if something happens, the less stressful life becomes. The less you start thinking about or worrying about money, I should say, because you know you've got that reserve. And you know if you don't work or have income for 6 months or a year or 2 or 3 or 5 even, you're fine. You could survive it. Now, most people don't have that. That's statistically. And, a lot of people live paycheck to paycheck. We've all heard that. Folks, that's stressful. You got to start changing some behaviors to eliminate the stress. Which is more important, the immediate gratification of spending on that item or living in that nicer home or that nicer car or whatever it may be, which is a short-term gratification thing. I understand it. I like that stuff too, like anyone does. Or is it better to reduce your long-term stress level of your life? Which is a better life? And why do I talk about this? Well, if you want to operate like the top 1%, you got to start thinking like the top 1%, okay? In other words, if you're going to change where you're at, change your financial future, first thing you got to do is change your thinking. And we talk a lot about that 10% because where's a good place to put that 10%, for example? Well, you can put it in the bank, a traditional bank. And again, I'm a banker. I'm a chairman of the board of a bank in formation right now, okay? There's a lot of things. Well, you can put it in checking, savings, money market, CDs. Safe in those places, but what kind of rate of return are you getting? And you have access to it. CDs not so much, but the others, money market and such. But what kind of rate of return are you getting these days? I see a lot of bank statements to show 0.0 something. It's terrible, okay? So if you've got a cash reserve, why not put it in a personal bank and get 3, 4, 5% guaranteed. 4% contractually guaranteed, or an index option where you can make double digits on good years, good market years, and not lose on bad years, which is key, by the way. You don't want to put it at risk. That's your reserves. You got to have that safe and you got to have it safe and accessible for those reserves. Well, your personal bank's a perfect fit or is a great fit for that. In most clients' cases that I deal with and work with, it's a great situation for them because the money was just sitting in the bank doing nothing. We call it dead dollars, earning next to nothing. You had it. We understood why you had it, covering those reserves, okay, and doing what should be done, but it's not working for you hardly at all. Well, at least in the personal bank, it would work for you and grow and move forward. Plus, you can get tax-favored growth. You have access to the capital if you need it without long-term loss of compound interest growth, okay? Contact us at yourpersonalbank.com. We can share with you more detail how that works. You have a long-term care benefit built in, and you have a death benefit built in for those catastrophic things. And those are all important things. Those are all important protection tools that most of us need, okay? You solve all that at the same time. But most importantly, I'm going to go back to you control your money, you have access to your money, and you reduce your stress. And that's the point I'm trying to make. You reduce stress. And what's more important than that? Okay? So, what are our financial needs through our lifetime? We talk about this a lot. We're taught as financial advisors you need income in retirement. And that is absolutely true. Most people do. But guess what? What I've come to realize and learn is through experience and working with lots of clients and various things is, when you're just starting out in your career, money-wise, what do you need? Well, you need income. When the car breaks down or roof leaks, what do we need? Income. We lose our job or our business income. What do we need? Well, we need money, income, to pay the bills. We got sick or hurt and can't work. What do we need? Income. And when we retire, we need income. So my point is, I keep going back to access to capital is key to financial success. Whether you're a business or an individual does not matter. because the reason is at every stage in our life, we have a need for income, okay? So building that cash reserve by using that 80-10-10 rule, putting 10% away over time and building that nest egg and then putting it in something that'll grow safely and has access to it with other benefits, my gosh, it just reduces the stress. It reduces the problem that people face so much in their lives, okay? And what are some good resources? Another question I got is, where do you go to find out more information? Well, I've shared many times, yourpersonalbank.com. We've got different articles, information there. You can go and listen to any of the pre-recorded shows. There's topics on it. You can listen to get more information on the personal bank concept. Let me give you a great book to read. It's Financial Independence for the 21st Century by Dwayne Burnell. You can get it on Amazon or anywhere else. It's about $25. There's a dozen or so books on this concept. I've read all of those that I'm aware of. And in my opinion, that's my favorite. That's the one I think that does the best job of explaining really how this concept works. And again, it's Financial Independence for the 21st Century by Dwayne Burnell. Now, I've reached out and talked to Dwayne Burnell just a few weeks ago. We had a great conversation. He's been in this industry for decades, and he knows Nelson Nash, who is who passed away recently. He knew him well, worked with him closely. Nelson Nash also has wrote a book called Be Your Own Banker. Probably my second favorite book. Another great resource to check out if you want to read or learn more about this concept. You can also go to infinitebanking.org. That's, again, infinitebanking.org. That is Nelson Nash's website. He's got decades of newsletters on there on this concept, on this idea. Why am I sharing this stuff? I mean, I have nothing to do with the book or the website. If you want a third-party resource that's credible, I mean, we all know you can go online and research anything, and you can find good and bad on it, just about any topic you want to. And we also know, most of us, that I shouldn't say a lot or most, but there's a good percentage, I'll put it that way, of information on the internet that's not entirely accurate. So to go to a credible source that knows what they're talking about, particularly on something like this that's not commonly known or well known by the general public, is vastly important. See, this concept, your personal bank is not shared commonly with the general public by the financial industry. And there's a number of reasons for it. I mean, one, most financial advisors are not familiar with it themselves or deal with it or handle it at all. So if they're not familiar with it themselves, why would they share it with somebody else? Okay? I mean, that's pretty obvious. There's a perception in the industry that this is for the ultra wealthy. And certainly the tax-favored benefits of it do make sense for the wealthy. It's kind of becomes a no-brainer in many cases. It's an obvious benefit. You talk about tax-favored, you talk about income tax-free growth and access to funds if you access these properly. That's something very positive for somebody, a high-income earner. So those high-income earners, those folks with high assets, this makes a lot of sense. It's immediately obvious, okay? But my point is real simple. I tell people, look, if I can help somebody reduce their taxes by, say, 10% overall, long term, and you make $500,000 a year, that's a pretty big deal. But what if you make $50,000 a year, but we reduce your taxes by 10% overall, for example? Is that a big deal to you? Well, guess what? I found out it is. The number of zeros behind whatever your income or assets are, it benefits that person percentage-wise, if you will, almost equally as much, or the impact, the difference is just as significant. How's that? Maybe that's a better way of putting it. It's a significant difference. It's a significant positive. But it's just not the tax benefits that's the key. It's the access and control of the money. That's the true key. And what I find is for folks with less, it's even more valuable. Because having access to ready access to cash when you need it is more valuable for the person who has less, because they have a greater need for it when things go wrong than the person with more resources. So it makes a bigger impact, a bigger difference for that person, and is even more valuable. And sadly, that's just not something that's commonly thought of or talked about in the financial industry. I talk about it all the time. And then the last thing I would say, the other real reason is, the industry, the financial industry, the advisors don't pursue it because, well, let's face it, there's more commission involved in a bigger case than a smaller one. And to be fair, if I had to go around and talk to 100 people doing, average American cases, let's face it, it would be hard to make enough to make, because we take a much smaller amount the way we structure these. I've talked about it in previous shows. Go to yourpersonalbank.com. The commission that's earned on a personal bank case is structured properly is much less for the advisor, less than half, by the way, than a traditional insurance contract is. It's significantly different. Like I said, less than half in most cases. I've just found a way through talking through workshops on the radio to get the information out to a lot of people in a effective manner. And then when we chat, I don't have to educate you on how it works. We can talk about you and your situation and how it works best for you. Contact me, 866-515-6280 or yourpersonalbank.com, or tune in every Tuesday at noon to Money Radio, 1510 AM, 105.3 FM.
Listen next week at noon for more information on Your Personal Bank. Contact Ference at 866-515-6280 or online at yourpersonalbank.com.
This show is designed to provide accurate and authoritative information. The presenter and guests on this program do not engage in rendering legal, accounting, or tax advice. Expert advice from a professional involving your specific situation should be sought, if required. Permanent life insurance is a long-term investment. Products, optional features, and riders may have limitations, restrictions, and additional charges and may not be available in all states. Withdrawals beyond principal may be taxable income. Excessive and unpaid loans may cause the policy to lapse. If a policy lapses, unpaid loans are treated as distributions for tax purposes. Replacements may not be suitable for everyone. There may be penalties and surrender charges when replacing coverage. New products may include new surrender charges and contestability period. Policy guarantees are based upon the claims-paying ability of issuing insurance company and do not apply to the investment performance or assets in the underlying variable portfolios. The life insurance and annuity products in this presentation are not FDIC insured, may lose value, and are not bank guaranteed.